Hi, I'm Arthur Zakowitz, and welcome to Corner of Fifth's Street Talk. This is where we share insights about fashion, apparel, retail, beauty markets, all stuff that's fun and going on. And today we have Cass, who's my co-conspirator at the studio. He's our creative director. I'm the director of content. And yeah, usually we just kind of like look at the past headlines from the week and discuss things that are top of mind. And it's been kind of a busy week. It was the kickoff to the holiday shopping season, the official kickoff, let's say, and then it became Cyber Week. So there's a lot going on, and there's also stuff going on in the economy, which I'm starting not to read the headlines anymore because some of it's depressing. But Cass, what did you find that was sort of interesting?
Well, that's funny. Actually, I keep everything I read at the moment. Well, yeah, everything I read always seems to end with the line, despite persistent economic concerns.
Right.
So even though everything seems to be positive, it's always, but there's something bad in the background, we're kind of worried about. So yeah, Black Friday apparently did very well. So yeah, the sales rose from a year earlier, according to a MasterCard post, a sign that the US consumers are continuing to spend despite persistent economic concerns. But the interesting thing I read on was Adobe Analytics. I've posted a couple of things. A few economists had picked up on it, and about how AI, or the e-commerce, particularly over Black Friday, has been driven by AI. And there's been an uptick of like over 800%. There's a report from Adobe Analytics that says, I think there should be context there. I don't think many people are using AI the way they are this year, the word compared to last year. So I think 800% on very little is probably not that much. But think of it as how ChatGPT or Gemini, you're doing a search for a product, and it's directing you there. So it's almost like circumnavigating a regular search, like Google or something. Though I'm sure a lot of it's using Google kind of platforms. Also, the data revealed that 38% of people are more likely to make purchases because AI had driven them there.
That's actually,
Which obviously demonstrates that AI is generating a lot of ROI, and it's quite a powerful tool. So yeah, I think winner here is really probably going to be Google. I think because also there's the amount of money they're going to invest into this as well. They've talked about in AI investment of 60 billion in the US alone, 15 billion in India. They're also spending money on AI startups. They're investing in money on AI education and workforce development. Now you're starting to see these returns. I think this is quite positive for the long term.
there was that same Adobe report showed that people are on their phones more. I think it was like 3 or 4 percentage points higher than last year. I think like 51 or 2% of people buying online were using their mobile devices. So they're on their phones anyway. They have their, whether it's Chat GPT or Google Gemini. So they're using these tools more frequently as part of their, lives, which we all know, we all do. But I'm glad you brought that up about the sales because the I want to dig a little bit deeper into that. The NRF, I think they put out a report. They had some numbers that it was a record number of consumers had shopped during the 5-day holiday weekend, it came into like 202 million people shopping. This is like traffic. And I think they said the figure is up from 197 million last year, which surpasses the previous record of 200 million set in 2023, which was in 2023, there was that post pandemic, let's get outside and have more experiences, and shopping became one of them. So there was a lot of.
And we just come out of a mini recession in 2022 as well. So
Right.
there'd been that kind of dip and there was a pickup.
But the NRF defines the holiday season as actually from November 1st through December 31st, and they're expecting growth of for the whole season of between 3.7 and 4.2% to over $1 trillion, which is a mind-boggling amount of money. But I think I want to kind of dig in a little deeper to what that really means. I think the results show that despite early reports of record traffic and strong sales, the real picture, it's kind of like, it's not as rosy. Anthony Carabas, who's a retail consultant, and he just put out a report this week. I think it's titled "The Paradox of the 2025 Holiday Shopping Season," and in it he says that we have to be a little cautious about that. There's again, he cited Adobe that showed consumers are spending a record $11.8 billion on Black Friday alone, which is a 9.1 increase just for that day. And he explains all the headlines. But he says, while the headline sales figures suggest a flourishing consumer environment, the underlying metrics reveal a crucial disconnect, often referred to as the Black Friday paradox. He says the core of the paradox is that while the gross dollar amount is rising, the actual volume of goods purchased is not keeping pace. So which is a direct kind of consequence, he says, of entrenched inflation. He said analysis from Adobe and other online tracking platforms, quote, revealed this vulnerability. Although total revenue increased, order volumes actually fell 1% compared to last year, with the number of units purchased per transaction dropping by 2%. So, right, the dollar sales are up. Inflation, tariffs, which are driving a lot of inflation, is pushing the unit sales down. People, they're shopping, but they're being more frugal, and they're definitely more, value.
But we reported all this, didn't we? About a month or so ago, everyone was predicting this is exactly what would happen. It was like, yeah, you made a lot more money, but there's not selling as many products. It's like, yeah, inflation, but we're not allowed to talk about inflation.
And of course, the industry has to be positive, and they're talking about the record number of sales and all that, and they're trying to, the veneer is trying to be positive and strong. Really, I think there's some concern in the market about how this plays out for the rest of the year.
I think it's true. It's like, if you look at the third quarter, a lot of those earnings are kind of all winding down now. Like 95% of the S&P 500 have all reported in. And staggeringly, there's been a double-digit jump for the quarter, which is just, again, we keep coming back to despite persistent economic concerns, things are going well. But again, I think we go back to that. It's the higher end,
right?
Part of the economy that's spending the money. The low, mid, median, and down are just not spending money. And there's been plenty of reports and stuff and in data coming through now about people tapping into their savings. And that's the first sign of a recession coming, because it's like that means people literally have run out of money. So they're paying for Christmas and they're paying for the holiday season, literally from their savings, which is not a good sign.
Or credit card debt, or using credit cards.
Yeah, credit cards. The first thing you max out is your credit card, and then you start tapping into your savings. You never want to touch your savings. There was Ernst Young again. There was a posting this morning about some of the data. Everything's flatlining at the moment. Yes, we did have this pop the third quarter, and we're done well for the Black Friday, but everything else is kind of flatlining. So auto sales are down for the year. And that's usually a bellwether for like what's going to happen in the economy. We also look at all the job cuts that are happening.
Right.
We talk about like Microsoft and Google going up. I mean, Google's up 49%, but this is a reflection of the stock market, not necessarily what's going on behind there. It's about where the investment is and what people think they're doing with the capital expenditure. It's whether their profits come home or not. I don't know. There's a lot of that speculation. Amazon was up, but it said it's down 21%. On packages
27
in the third quarter, 21% delivered, 21% fewer packages.
That's
people
huge.
aren't spending. That's huge for Amazon.
Huge.
I mean, again, who uses Amazon? It's usually middle market and below.
Wow.
So that's also, that's Macy's came in yesterday. They've just said that they've got a drop in earnings. So it's all kind of like,
So and it's interesting you mentioned Macy's. There was a report from Placeit.ai, and they do location data, etc. And they showed there's some strength. When you look at like traffic, people did go out to the malls, but they weren't really buying. A lot of it was like I think it was 130% uplift in traffic at the department stores, for example. So people were going out and they want to experience like shopping, but that doesn't necessarily mean they're buying. As much as they did. So I'm not surprised to see some caution on the part of Macy's.
I also think people want those experiences. They want to it's about, you're going out with friends and communities and families. There's a lot of that going on. The people want to kind of have those experiences still, but you don't have to spend, just still go out and have a good time. You just be careful what be a bit more economical with your expenditure.
So Anthony Carabas, in his report, he's got 5 kind of implications, 4 or 5 implications, and he talks about the fragility of momentum, which we talked about that before. Consumer confidence is declining. So if that's going to drag down any momentum that there is in the market, and then At the same time, there's this shift in purchasing towards like more affordable luxury, let's say, or kind of more value-based products that you're going to be focusing on. And he's got some action items, and I'll just read a couple of these. It's pretty interesting. So, amid these concerns and slagging consumer, confidence, he says you have to, his one strategy, create dynamic tiered promotions. So he says the goal is to minimize margin erosion while maximizing conversion rates. So retail should move away from, blanket 20% off of everything sales and instead implement personalized tiered promotions based on customer data. So, for example, if you spend $150, you get $30, or you get $25 off for loyalty members. So it's different. You're using your data to look at like your more loyal customers and giving them a different deal than you would, others. He said this incentivizes higher order values and provides the consumer with the feeling of a deal without sacrificing margins across the entire inventory. So using that, it's kind of manipulation, but it's you're protecting your margins, and every percentage point, every basis point counts in this kind of market. So and then he talked about returns too, the importance, having a seamless experience with fulfillment and returns as well. So it kind of mitigates anxiety on a consumer, and the consumer has a bad return experience, they're gonna like not. It doesn't favor well for your brand. So it's interesting on it.
100%. I mean, you and I probably have had that similar experience. You're buying something, it doesn't quite fit, and you want to send it back, and if it's a struggle, like, why are you making this so hard for me?
Make me.
So one of the things that I've been looking at also is the job cuts. We looked at over September and October, and because of like the government shutdown, we weren't privy to some of the numbers there. So November dropped by 71,000, which was half of October. It was the worst since 2022. But October's was a job cuts of 153,000. Was a 183% surge from September, and it was the worst job cuts since 2003.
Wow.
The worst in 22 years. So yes, it's got a little better. I mean, 71,000 is still not great being job cut, but there's huge numbers there being cut back on. That's going to have an effect at some point. So next, I'd like to talk about Nike. The Nike's feeling like Nike again. It was a nice headline I saw the other day, and it kind of reminds me of what I'm seeing. I mean, obviously this is coming because they've had a new CEO that came and played a couple of years ago. They got rid of John Donahoe, who they brought in, who was very much kind of data-driven. He gutted all the marketing and design departments. He slashed all the marketing spend. He basically chased the data. So whatever was doing well, he goes, okay, go down that. We'll follow that route. It seemed quite smart at the time. He realized if we did get rid of all the marketing spend, if we just give the product to our sponsored sports guys, whoever the best Nike basketball player is, etc., footballer, they just do a social post with their shoe, whatever it is, that will drive sales. And it kind of did for a while. And he also kind of tapped into the retro sneakers as well, which is a smart idea. And he did well for a bit. But then what happened? He started to lose brand loyalty. There was no brand marketing. Nike wasn't Nike anymore. Nike wasn't cool anymore. And because they weren't creating these amazing ads, people kind of lost interest in them. And so they led to a 10% downturn, which was quite significant for Nike, as you can imagine, being one of the biggest brands out there. So he lost his job, and Elliot Hill was brought back in 2 years ago. So now you've got this sudden shift back to what the old school Nike was. And, you can imagine, if you remember back in particularly the 80s and 90s and stuff, when they were doing Air Force Ones and Air Maxes and the Jordans and the Hurricanes, Huaraches. I remember, like, as a soccer player myself, the Total 90 and the asymmetrical lacing that they used to have offset.
Right.
The ball wouldn't hit the laces. So I think it was wild at the time. So all that innovation and all those amazing ads that they used to do for the last 20 years, he's starting to bring that feel back. And they've got a couple of products out there. And one's a battery-powered Project Amplify anklet, which is something you strap to your calf and attaches to your shoe and basically gives you extra boost when you're running, which is amazing. So it's kind of wild to look at. It just looks like a kind of, I don't know, some kind of mini skeleton on the back of your shoe. but apparently it's very effective. It's basically this the first generation product isn't designed for competitive use. It's intended to serve athletes who want to go faster and farther with less effort by giving them more power for everyday movement. In effect, a second set of calf muscles. I thought that's wild. The other one they've also brought in is Mind 0.1 and sorry, 001 and Mind 002 trainers, which is designed in collaboration with neuroscientists to improve the connection between the mind and the body. Described as by the company as the first neuroscience-based footwear, these are the first shoes designed from the brain down, not the ground up. So if you look at these things, they're kind of wild looking. They're kind of like bubbly shoes, and on the bottom there's all these little bubbly balls. So obviously, as you walk, they kind of obviously touch your feet and giving you that sensation, which obviously stimulates the brain, I'm presuming. Talk to the neuroscientist, I'm sure they'll give you a better description of what's going on there. But this, you're like looking at these things, I'm never going to wear these, but they're probably quite an amazing experience. So they're creating these quite kind of like wild, interesting, conceptual kind of shoes, which is, yeah, they may not end up at market, but it creates an interest around the brand.
It spotlights the brand, exactly. That innovation like that, and people talk about it. They may not buy it right away, but yeah, it's going to showcase the brand, definitely.
Totally. And it's like they've also got something next year coming called inflatable coat called a Air Milano. So I'm kind of excited to see what that looks like about. It's a bit like, cars, they do concept cars. Most of them never make the market, but just parts of it will eventually trickle down into like the main brand. So I think, yeah, I think Nike have started to find itself again. And I think that's quite always exciting. They're a good brand. Always fun to watch.
All right. So right now we have Max Vaughn, who's the founder of Seventh Online, a technology company based in Manhattan, and he's going to discuss how to leverage technology to drive conversions, profits, and sales. Welcome back, and welcome, Max Ma, founder of Seventh Online. Great seeing you again. It's been, I think we spoke last year, was it, or
early this year?
Early this
right.
year. See, time goes fast.
I know.
But good seeing you again. And I think I was trying to figure out like what's a good place to start. But let's start with the name Seventh Online. Can you walk us through where the name came from, and what was the problems that you thought needed a solution?
Yeah. So my first job in New York City in early 90s, I worked for a fashion company off 7th Avenue. So and I got to learn the 7th Avenue neighborhood, which is also called the Fashion Avenue. Right. So there are all kind of set up their showrooms, their headquarters from Times Square down to Madison Square Garden. So when I work at my first job, I realized, oh boy, there are a lot of issues with this industry, right? Everybody is making hundreds of millions of dollars, maybe billions of dollars inventory decision without much rationale behind it. So that's why when we try to do something for this industry in late 90s, so we thought about bringing 7th Avenue online so that everybody can collaborate, can do something with the technology space. So that's why the 7th Online name come from.
So, we've actually talked about this before on our show about technology and companies having very large tech stacks that don't integrate, and a lot of people still using Excel spreadsheets and loading that up. What is Excel hell, and how do you get out of it using your platform?
Yeah, so that's a really good question. So we call it Excel hell. Excel was built by, Microsoft originally, not for the purpose of inventory planning or retail planning. So the problem with Excel is everybody get their own versions, own formulas, not mentioning the errors now associated with it. People type in a wrong number, there's no check. So the main problem with Excel is it's disconnected from, each other, right? As a corporation, it's very hard to interject disciplines, standards, and uh, uh, you know, implement processes. And today, everybody talk about AI,
Right.
right? How could you embed AI algorithm into Excel, which I haven't seen it. Microsoft came up with Copilot, which is just
Copilot. Yeah.
interaction, between human beings and Excel. But in terms of leveraging the technology, it really limits the potential of technology. So we have seen many customers moved away from Excel onto centralized system to conduct their planning, processes. So by doing that, they eliminated the silos between, individual Excels, and eliminated all the errors associated with it, right? So, for instance, one of our clients, one of the early clients told us, this was more than 20 years ago, that by just moving everybody, all the AEs from Excel to our system, this is one brand. They saw tens of millions of savings from, imbalance between demand and the supply.
I guess the biggest issue, aside from saving money, is getting data and information as up to date, almost in real time, right? So that's going to free up me, if I'm a merchandiser, to focus on what's important, which is merchandising, which is not, you know, tracking numbers and making sure everything is aligned and connected, right?
Yeah. Yeah, we have another client, use our system. They told us before they use our system, they use Excel, they use other, antiquated tools. It, used to take them 2 weeks to build merchandise financial plan for a season. By using our tools, they can cut that 2 weeks down to at least one day, if not just a few hours.
Amazing.
So what does that mean? So we always talk about, you productivity improvement. So our clients told us by improving the efficiencies, they can spend more time to talk to store managers, to understand supply chain, to understand what's coming in the trend, so that they all spend 2 weeks become Excel junkie. Copy paste data from BI tools, and then figure out formulas. So they don't have to do that anymore. They should focus on running the business instead of letting Excel run their life.
Which I think, especially now, I think that's really important because there's so much disruption in the market, and it's not. I'm not talking about disruption in the store or the operations, things that are outside the control of the retailer. Right? I have no control over tariffs. I don't have control really over the supply chain. So freeing up all that time lets me kind of react and think about and mitigate those issues. Right?
Yeah. So with continued rising of e-commerce and the demographic changes, right? The younger generation shopping behavior completely shift away from the old way of consumer behaviors. Retailers needs to really spend time away from managing Excel sheets.
All right, Excel hell, let's get out. So, in your mind, what's the biggest disconnect that you still see, I guess, in the retail vision and execution?
Yeah. So I'm in the technology space, right? People talk about, even retail management has this AI on their, you know, mind all the time. But we haven't seen much movement in terms of really improve their business by having meaningful technology or AI technology, implemented in different areas of their business. For instance, we are in the planning business, right? So we try to help our customers to really figure out what will be the future consumer demand so that they can match up with the supply chain. So that's one big
To disconnect.
disconnect.
Yeah.
And another thing is having the merchants really understand their market, their segment, their their consumers, how to do that,
Right.
right? If you don't have the right tools, I guess you can only do so much. Let me give you one example. We have done over the years to improve localized size profile in every single store, right? People, this is one thing you have to connect your store with your consumer. Each store is determined by the, consumer live or work around the stores. We're talking about 3 mile or 5 mile radius, right? Those people, how are you going to understand? By counting fingers, you're not going to be able to achieve that.
Right.
Today, there are this great, technology focus, and AI can give you down to each SKU, each store, the right mixture of size profile, right? This way, you are not going to run into, you know, out of size
Right.
and then left over with unsold sizes. But nobody is doing that. People still, by and large, very manual on determining the size capability. What is one size fits all?
Right. But the problem with that is that you lose money. You'll have higher returns, right? And you're not maximizing the gross margin on a SKU level, right?
Yeah. See, this is the problem we have seen for so many. I've been in retail business for 30-some years, and the margin, the net margin, is so bad, right? And that end up, developing all kind of problems because the margin is so slim. They couldn't get the right technology for the business. And without the right technology, you cannot develop higher margin business. And then this bad cycle just keep going. For the past 30-some years, I have seen this industry just stay in that, dark cycle.
So that's the other thing I've noticed. It seems retail, fashion apparel in particular, is very slow to adopt new technologies. And when they do, it's like Gen AI, and they do it without thinking, right? So how do you do that? How do you break out of that dark cycle, like you just said? How do you know what investments to make and how to do the right assessment of your business to determine which technologies you need?
So everybody jump on the, ChatGPT, use ChatGPT to handle their, certain automations. For instance, customer service, right?
That makes
So, but AI fields has had so many different variations. Large language model is just one of the many. So what we've been doing is advanced data analytics using AI, right? Developing AI models for bits and bytes, not just for texture, language information. So for retailers, they need to understand what problems they want to solve first. Instead, I need to implement AI. Today, there are many specialized tools for all different kind of problems. I guess they need to empower their IT team to understand better business problems, right? And really, drill down to what are the specific issues they are facing. It could be customer service,
right.
right? It could be, clienteling, right? And it could be inventory. But different problem has to be solved by different type of solutions. Not everything with ChatGPT.
So NRF is coming up, and people go there, executives, they get all excited. They find technologies that are kind of amazing, and it's going to bolster margins and improve sell through, and they get very excited. It's like I describe it like an opium den. So they all get excited and high on the technology. Then they go back to their headquarters and they knock on the CFO's door and says, "We need this technology," and they say, "No, we can't afford it." So how do you change the culture on that level to make executives understand the need for the right technology, not just wasting money on chat gpt, but picking the right set of technologies. How do you convince the culture to change and get their mindset in that gear?
Yeah, using your analogy, they maybe should suck on opiates every day. That's a joke. I mean, there needs to be a constant drive, right? Understanding like where they met, technology, right? And NRF, right? They need not just go into NRF and get high and then go home back to the reality.
Yeah, the reality.
So, you know, I mean, reality is always making people comfortable,
Yeah.
but it's always about taking people out of their comfort zone. I think most of management, they understand that, but the question is how, right? So, they can have programs, keep them always up to date,
Okay.
right? I mean, we've been out there all the time talking to clients, attending events, and so as many of, other technology companies. I mean, management, they needs to really uh, keep this in their mind. I know retail is tough. The low margin problem is killing everybody, right? Again, back to Excel, occupy all their, work hours. So again, how to really free themselves up to have more educated, knowledge with what they try to use technology to solve.
So that's the other thing. Instead of chasing margins, why not focus on the customer, what they need, how they shop, where they shop, kind of approaching the shopping journey as the goal, really figure out what consumers want. And then you could back into, okay, what technologies do I need to meet them there?
Yeah. So there are different ways to slice and dice what consumer want, right? So there are CRM tools, right? Empowered by AI. And there's also planning tools. Planning is indirectly using the sales data to understand, the demographic distribution of consumer sectors or, to forecast future consumer demand, right? So there are tools, there are, areas of new development the retailers should focus on educating themselves with. And you go to NIF, I guess 99% of the exhibitors will put up AI there,
And
right?
so, and what about you just mentioned that you said about the different channels, right? So, everybody talks about, omni-channel retailing, and that's the key to this, but integration of that is very difficult, integrating those pathways. Do you help retailers and brands solve that problem?
Yes. Most of our clients are in, we call multi-channel. Forget about, I mean, people came up with omni-channel, meaning brick and mortar
Right.
versus
Online,
e-com.
yeah.
But multi-channel is more than, brick and mortar e-com. It has wholesale distribution, has franchise, and a global, right? So our business from day one, 26 years ago, has been built on that journey to help retailers to manage all channel of distribution by having centralized planning and inventory positions so that they know which channel may need more inventory. So we have probably one of the few multi-channel merchandise planning tools in market, and we help people to have integrated inventory planning process in place. For instance, we have a client that have about 250 stores, but they have 3,000 distributors. It could be specialty stores, could be mom and pop shops, and ski resorts. So we actually allow them to first segment different channels, retail, plan their way, and wholesale plan their way. And then we have a platform to integrate retail demand and wholesale demand that become their corporate demand. That's what they need to place the inventory buy with their suppliers down the supply chain. So that has been our sweet spot over the years. Multi-channel is always one of the biggest challenges for our brands.
So what is last question? What is, as we look to 2026 through the year, and especially given all this activity in the market, this economic kind of changes and challenges, what do you see? What does the industry as a whole need to address? What's important?
Yeah, so with a lot of uncertainty down the road, this tariff, I just heard from a client, they budgeted that this is not a huge client, maybe several $100 million business. They have to budget between $20 to $30 million actual tariff payment. That cuts into a lot of things, cut into their margin, cut into their technology spend, cut into their store renovations, right? So how to really mitigate that kind of risk? We believe having the right inventory position, right? Before, the mistakes cost much less,
Right.
$20 to $30 million less than today. So I think retailers should really, use this tariff as a wake-up call to be precise on their inventory decisions. Besides excess inventory, out of stock because of not enough inventory is a killer for retailers. So all these problems can only be solved by having the right tools and have the streamlined supply chain.
Thank you so much. Good seeing you again. Maybe
Yeah,
we'll
it's nice seeing you too.
We'll have you back another time. So thank you again, Max, and
Thank you, Arthur. It's always a pleasure speaking with you.
same here. And thanks for tuning in.